The information provided in this video is for informational purposes only and reflects the personal opinions of its creator. It should not be considered legal, financial, or investment advice. If you're considering starting a venture capital fund or engaging in fundraising activities, you should seek professional legal assistance to ensure compliance with the laws and regulations of your country. Venture capital is a business of long-term commitments, and for general partners, compensation structures must align with both investor expectations and the fund's long-term success. The economics of a venture capital fund are built on two key components: management fees and carried interest. These define how fund managers are paid, not just for overseeing the fund, but for delivering returns to their limited partners. For LPs, negotiating a fund's compensation package is about ensuring that incentives are properly aligned. A well-structured fund should balance covering operational costs in the short term while ensuring that GPs are truly invested in generating high returns over the long run. But this is not a one-size-fits-all equation. The terms that govern compensation depend on the fund's size, strategy, and the experience of its managers. The management fee is the baseline compensation that allows a fund to operate. It covers salaries, due diligence costs, office expenses, legal fees, and everything else required to keep the firm running. Typically, this fee is structured as a percentage of assets under management, the AUM, with the industry standard hovering around 2% per year. For a $100 million fund, this means an annual management fee of $2 million, distributed across the fund's life cycle. However, management fees are not static. They often decline over time. Early in a fund's life, when deal sourcing and portfolio construction require the most effort, the full 2% fee is justified. But as the fund matures and shifts toward monitoring portfolio companies rather than making new investments, fees often step down to 1.5% or lower. LPs want to ensure that management fees are sufficient to run the firm efficiently but not excessive, preventing GPs from being overcompensated before proving their ability to generate returns. For emerging managers, especially those raising a first fund, convincing LPs to accept the full 2% fee can be a challenge. Many LPs expect first-time funds to operate on leaner budgets, and GPs must justify why they need the full fee structure, especially if the fund is smaller than $100 million. In some cases, newer funds accept a tiered structure where management fees are higher in the early years and gradually taper down. While management fees keep the lights on, carried interest is where real wealth is made. Carried interest, or carry, is the performance-based compensation that GPs receive when their investments generate profits. It is a share of the fund's profits, typically 20%, distributed to the GPs once LPs have received their original capital plus a pre-agreed return hurdle. This means that if a fund deploys $100 million and generates $300 million in total returns, the $200 million in profits would be split between LPs and GPs, with the GPs receiving $40 million, 20% carry. However, carry is not guaranteed. It is only earned if the fund is profitable. To protect LPs, most funds include a hurdle rate, a minimum return threshold that must be met before GPs receive their share of the profits. While venture funds typically do not impose hurdle rates, some LPs insist on them, particularly in markets where alternative asset classes like private equity do. Another key negotiation point is the distribution waterfall, the sequence in which profits are distributed. In most VC funds, a European-style waterfall is preferred by LPs, meaning that GPs only receive their carry after all LP capital has been returned. Some funds, however, negotiate for an American-style waterfall, which allows GPs to take carry on a deal-by-deal basis, rather than waiting until the end of the fund's life cycle. For LPs, the objective is to ensure that GPs are rewarded for success, but only when LPs have already seen returns. This is why LPs scrutinize carry structures carefully, especially with newer managers who have yet to establish a strong track record. One of the most important signals of alignment between GPs and LPs is the GP commitment amount of personal capital that fund managers invest alongside LPs. Typically, general partners contribute 1 to 2% of the total fund size, though this varies. For a venture capital fund of $100 million, a 2% general partner commitment means that the general partners are required to invest $2 million of their own capital into the fund. This commitment serves two important purposes. First, it provides assurance to the limited partners that the fund's managers have real skin in the game. By contributing their own money, the general partners demonstrate that they are personally invested in the fund's success and will only benefit financially if the fund performs well. Second, this structure discourages excessive risk-taking. Knowing that their own capital is at stake, the general partners are more likely to act prudently and align their decisions with the long-term interests of the fund and its investors. For emerging managers, this can be a challenge. Raising a first fund often means GPs do not have significant personal liquidity, making it difficult to contribute millions of dollars upfront. In these cases, LPs may allow GPs to defer part of their commitment, financing it over time through management fees or rolling it from future carry distributions. However, the expectation remains that fund managers must have some meaningful personal capital at stake. LPs often scrutinize GP commitments closely. A team that invests too little might appear to lack conviction, while a commitment that is too high could signal financial strain, raising concerns about whether the fund's managers can maintain focus over the full fund cycle. Venture capital compensation structures balance short-term operational needs with long-term performance incentives. Management fees fund day-to-day operations, but carried interest is the primary financial motivator, rewarding GPs only if they generate strong returns. GP commitments reinforce alignment with LPs, ensuring managers have personal capital at stake. Fund negotiations shape terms around fees, carry distribution, and risk alignment, with experienced firms securing standard terms while emerging managers must justify their structures. Ultimately, a well-designed compensation model fosters trust and aligns all parties toward maximizing returns over the fund's life cycle.